Stock Market Trading Level 2. Trading Small Caps. In this video, we'll be discussing the concept, advantages, and risks of small cap trading. Small cap stocks have a bad reputation. The media usually focuses on their negative side, saying they are risky, frequently fraudulent, and lacking in quality that investors should demand in a company. Certainly, these are all valid concerns for any company. But big, large-cap companies have also fallen prey to issues of internal fraud that virtually destroy shareholder interest. Clearly, company size is by no means the only factor when it comes to investors getting scammed. Knowing the key factors in this trading genre will help you decide whether investing in smaller capitalized companies is right for you. Before we get into the pros and cons of small caps, let's just recap what exactly we mean. The term small cap refers to the stocks with a small market capitalization, between $250 million and $2 billion. Stocks with a market capitalization below $250 million are referred to as microcaps, and those below $50 million are called nanocaps. Small cap stocks can trade on any exchange, although a majority of them are found on the NASDAQ or the OTCBB, because of those exchanges' more lenient listing requirements. It is important to make the distinction between small caps and penny stocks, which are a whole different ballgame. It's possible for a stock to be a small cap and not a penny stock. In fact, there are plenty of small caps trading at more than $1 per share, and with more liquidity than the average penny stock. So why invest in small cap stocks? While small caps have their negative attributes, which we'll get into shortly, they have a number of positive factors too. Let's examine 3 of the most compelling reasons why small caps deserve representation in many investors' portfolios. Firstly, there's a huge growth potential. Most successful large cap companies started at one time as small businesses. Small caps give the individual investor a chance to get in on the ground floor of younger firms that are bringing new products and services to market or entering new markets altogether. Everyone talks about finding the next Microsoft, Walmart, or Home Depot, because at one point, these companies were small caps. Diamonds in the rough, if you will. Had you possessed the foresight to invest in these companies from the beginning, even a modest commitment would have ballooned into a tidy sum. Because small caps are just companies with small total values, they have the ability to grow in ways that are simply impossible for large companies. A large company, one with a market cap in the $1 billion to $2 billion range, doesn't have the same potential to double in size as a company with a $500 million market cap. At some point, you just can't keep growing at such a fast rate, or you'd be bigger than the entire economy. Mature companies have limited organic growth rates because they already address a larger proportion of their target market. Any new product or service represents a smaller proportion of total revenue than the established product offering. For these reasons, earnings and cash flow growth in large cap stocks can be limited, unless their corporations acquire other firms. If you're seeking high growth companies, small caps are the place to look. Another advantage is that most mutual funds don't invest in them. It is uncommon for mutual funds to invest hundreds of millions of dollars in one company. Most small caps don't have the market cap to support this size of investment. In order to buy a position large enough to make a difference to their fund's performance, a fund manager would have to buy 20% or more of the company. The SEC places heavy regulations on mutual funds that make it difficult for the funds to establish positions of this size. This gives an advantage to individual investors who have the ability to spot promising companies and get in before the institutional investors do. When institutions do get in, they'll do so in a big way, buying many shares and pushing up the price. Finally, small caps are often under-recognized. This third attribute of small caps is very important. Small caps often have very little analyst coverage and garner little to no attention from Wall Street. What this means to the individual investor is that because the small cap universe is so underreported or even undiscovered, there is a high probability that small cap stocks are improperly priced, offering an opportunity to profit from the inefficiencies caused by the lack of coverage devoted to a particular area of the market. Now let's get into the drawbacks of small cap investing. Despite the fact that small caps demonstrate attractive characteristics, they are not without inherent drawbacks. Finding time to uncover that small cap is hard work. But besides the extra time for research, there's the risk factor. In terms of equity categories based on market capitalization, small caps are the fourth riskiest group out of 5. Often, much of a small cap's worth is based on its propensity to generate cash, but in order for this to happen, it must be able to scale its business model. Now, this is where much of the risk comes in. Not many companies can replicate what US retail giant Walmart has done, expanding from essentially a mom-and-pop store in Arkansas to a nationwide chain with thousands of locations. Their smaller balance sheets are less insulated from changes in the economy and poor economic conditions. Additionally, small cap stocks tend to have much smaller customer bases, so their prospects are more uncertain and tied to a specific regional area. As a result, many small cap stocks are unable to survive through the rough parts of the business cycle. Small caps are also more susceptible to volatility, simply due to their size. It takes less volume to move prices. It's common for a small cap to fluctuate 5% or more in a single trading day, something that some investors simply cannot stomach. And since these stocks have less liquidity, some may not be able to exit a position at the market price, and this possibility is greater during a market panic. So, the money you invest in small caps should be money you can expose to a much higher degree of risk than that of proven cash-generating machines like large caps and blue chips.